Fed cuts rates, but signals a pause is coming. The Federal Reserve cut rates a quarter point on Wednesday, but policymakers were unusually divided. Two voted for rates to stay on hold, and recent Trump appointee Stephen Moran for a bumper half-point cut. They also can't agree on the way ahead. In the new set of forecasts, 7 out of 19 policymakers saw no more cuts in 2026. 8 saw at least 2, and one, almost certainly Stephen Moran, thinks rates should fall to only just above 2%. Aoifinn Devitt is senior investment advisor at Moneta. Aoifinn, what should the market make of just how divided policymakers are?
Should take a lot of consolation from that, actually, because it shows that this is a nuanced and difficult thing coming down the rate hike mountain that was set up. And this is where errors can be made. It's very precarious. There can be stumbles. They can overshoot. And I think it's right that there is a careful data dependency in place. And if the answer were easy, it would have been done long ago. So I think to have this kind of dissent, this debate, and recognizing the cognitive dissonance that all market participants are experiencing today, which is that there are real concerns on the inflation and the job front, and in certain parts of the economy. And on the other hand, there is a very strong and exuberant market, which can ultimately foster more inflation. So I would say having to thread that needle very carefully is key. And as for the vote for a bumper rate cut, well, I think it's somewhat easy to be an extreme voice when you know that there will be ultimately consensus that is below that. So perhaps it's important to stake one's claim, to have the argument at least, but not necessarily believe that a jumbo cut is the right way.
As you say, policymakers are data dependent, but they don't have any very up-to-date data because the shutdown meant it wasn't released. We should get November's jobs report and inflation finally next week. What will be most crucial there to listen out for?
Well, certainly we're going to be looking at that jobs number. As you mentioned, there has been a bit of a data desert in that respect, a black hole given the shutdown. And it's always been difficult, given the revisions backwards, to really understand what we're looking at when it comes to labour data. So there will be a look for any shocks there, particularly in the lower end segment, which affects the consumer on this K-shaped recovery, where the consumer really is starting to feel the pinch. So a lot of look at that. And equally, inflation is going to be watched carefully. We've had a buoyant retail shopping season in the US so far, and that probably very likely has been accompanied by fewer price cuts and could well be supporting an even higher inflation number. So lots to look for.
Now, President Trump said after the vote that rates should be much lower. He is, of course, about to appoint a new chair. How concerned is the market that that person might diverge from the data to do what the president wants?
That has been a real concern, but I would suggest that has been somewhat discounted and already factored in, because there's a strong sense that the current chairman is currently in the twilight of his tenure. He is going to be, I think, resilient with his beliefs and resistant to pressure. We've seen that. So nothing's going to change while he is chairman, but we know that change is on the horizon. So I think markets are discounting that in, expecting it. But equally, this concern around running hot, this is probably why the dissenters around a rate cut have been so vocal, because they know they will have to continue being vocal to offset that strong orientation towards more rate cuts. So I expect lots of debate in these meetings in the month and years ahead.
Do you think those dissenters are right? Will stronger growth next year mean the Fed doesn't need to cut any further?
I think it will always be there in the toolkit, and certainly in terms of where we are heading to, I would suggest that a 2% level is too low, and certainly getting back to 0% is probably unlikely. But if we can hover in this corridor around 3%, plus or minus, I think there will be then just a kind of a way for navigation. There will still be dry powder in order to provide that incentive and the stimulus to the economy should the economy falter. But equally, there will still be a meaningful rate of interest so that cash can still earn something. And at the same time, it does not deter, say, house purchases. So it is about threading the needle. But I do think that having many voices contributing to this cognitive debate is very important.
But if this is the lowest the Fed goes this cycle, or at least in 2026, what does that mean for markets? Haven't they positioned for more cuts than that?
They have, but markets have other, I'd say, dynamics that are driving them. We know there's plenty of upside potentially on the narrative around AI. There's also the potential for downside around AI. But we also have to look at global trends. The global trend today around the ECB, the Bank of England, is that there could well be a flattening out of their rate trajectory and even a tick upwards in the case of the ECB. So it wouldn't be prudent for the Fed to be totally diverging from other central banks, because that will have a knock-on effect on the dollar. It should go weaker with that type of a rate trajectory. So I think markets will cope with whatever is thrown at them in 26 in pretty much the same way as 25. A careful reiterating of what the current dynamics are and ploughing ahead. So I think it's difficult to forecast how they would receive a flattening of rates.
That was Aoifinn Devitt of Moneta. Don't forget you can watch more videos on Reuters.com.